Question 1. Mr. Harper is considering purchasing a homeowner's insurance policy. He lives in a high-risk flood zone but is not sure if he should include flood coverage in his policy. Which of the following is the correct course of action for Mr. Harper? A. Flood insurance is included in standard homeowners policies in high-risk zones, so he does not need to purchase additional coverage. B. Flood insurance can be added to his homeowner's policy through an endorsement if he wants to be covered for flood damage. C. Flood insurance must be purchased separately through the National Flood Insurance Program and FIP if he wants to be covered for flood damage. D. His homeowner's insurance will automatically cover flood damage if he lives in a high-risk flood zone. Answer. C. Explanation. Flood insurance is not typically included in standard homeowners policies, even in high-risk zones. To ensure coverage for flood damage, Mr. Harper must purchase flood insurance through the National Flood Insurance Program (NFIP) or a private insurer that offers separate flood policies. This is clearly outlined in the National Flood Insurance Act and further emphasized in Oklahoma's regulations regarding flood coverage. It is important for individuals living in high-risk flood zones to be aware of this requirement and to obtain flood insurance to avoid financial loss from flooding. Question 2. Which of the following actions would be considered a violation of Oklahoma's unfair trade practices regulations for insurance producers? A. A producer offers a $500 rebate on a life insurance policy if the client agrees to purchase an additional rider. B. A producer uses an agent's written consent to claim a commission on a policy renewal even though the agent did not actively participate in the renewal. C. A producer provides a policyholder with truthful information about policy exclusions without any misleading statements. D. A producer advises a client that the insurance premium will increase by 5% annually based on the insurer's historical rate increase trends. Answer A. Explanation. Offering a rebate or any other form of inducement that is not explicitly allowed in the policy is a violation of Oklahoma's unfair trade practices. According to Oklahoma's insurance code, rebating the offering or giving of money, goods, or anything of value not specifically allowed in the policy is prohibited. This is considered a form of unfair competition and violates consumer protection standards. The law is intended to prevent deceptive practices and ensure that all consumers are treated fairly in the marketplace. Rebate violations can lead to suspension or revocation of the producer's license. Question 3. In a situation where Mr. Carter is applying for health insurance, which of the following actions would most likely result in a denial of his application due to underwriting concerns? A. Mr. Carter fails to disclose a previous back injury that healed over 5 years ago. B. Mr. Carter has a family history of diabetes, but he has never been diagnosed with the condition himself. C. Mr. Carter discloses a history of high blood pressure, which is well controlled with medication. D. Mr. Carter does not list a recent physical exam, but states he has had no health concerns in the past year. Answer A. Explanation. Failing to disclose a material fact such as a prior back injury which is relevant to the underwriting process can lead to a denial of the application or a policy rescission. Underwriting involves evaluating risks based on a client's full medical history and lifestyle. Non-disclosure or misrepresentation of material facts is violation of insurance ethics and can result in policy being voided if the insurer later learns of this omission. In Oklahoma, as per the Department of Insurance regulations, insurers are required to be fully informed about an applicant's health conditions to assess risks accurately. Question 4. Which of the following is the most likely consequence if an insurance producer fails to comply with the Oklahoma Insurance Department's continuing education requirements? A. The producer's license will be automatically renewed with penalty. B. The producer's license may be suspended or revoked. C. The producer will be required to pay fine, but no further action will be taken. D. The producer will have to retake the licensing exam before their license can be renewed. Answer B. Explanation. In Oklahoma, failure to meet the continuing education requirements for insurance producers can result in suspension or revocation of the producer's license. The state mandates that licensed producers complete specific number of C hours to maintain their license. Non-compliance may lead to disciplinary action by the Oklahoma Insurance Department (OID), including suspension or revocation of the license. This is outlined in the Oklahoma Insurance Code, which requires that producers engage in ongoing education to stay current with industry laws and practices. Question 5. Which of the following is A primary difference between term life insurance and whole life insurance. A. Whole life insurance covers policyholders for a specified term, while term life provides lifelong coverage. B. Whole life insurance includes an investment component, while term life insurance is purely protection-based. C. Term life insurance is generally more expensive than whole life insurance for the same coverage amount. T. Whole life insurance premiums increase annually, while term life insurance premiums remain fixed. Answer B. Explanation. The primary difference between term life and whole life insurance lies in the inclusion of an investment component in whole life policies. Whole life insurance offers both a death benefit and a cash value accumulation component, which grows over time and can be accessed by the policyholder during their lifetime. In contrast, term life insurance is purely for providing a death benefit and does not accumulate any cash value. This is a fundamental distinction based on the structure and purpose of the policy. Question 6. Mr. Thompson is applying for health insurance under an HMO plan. He has recently been diagnosed with diabetes, but he has been managing it well through diet and exercise. The insurer asks about his medical history. What is Mr. Thompson's best course of action to avoid complications during the underwriting process? He should withhold information about his diabetes since it is well controlled and not relevant to his health at the moment. B. He should disclose his diabetes diagnosis fully, including details of his management plan to ensure accuracy in the underwriting process. C. He should only disclose his diabetes if asked directly about it by the insurer. D. He should only mention that he is managing his diabetes well and avoid providing the specifics of his treatment. Answer B. Explanation. Full disclosure during the underwriting process is critical, especially when dealing with chronic conditions such as diabetes. Insurers have the right to assess risks based on all known medical conditions, even if they are well managed. Failing to disclose such a condition could result in the denial of coverage or the voiding of the policy if discovered later. Oklahoma's regulations require that all material facts be disclosed truthfully, and non-disclosure is considered a form of misrepresentation, which can lead to legal and financial consequences. Question 7. Which of the following is a correct statement regarding the principle of indemnity in property insurance? A. The principle of indemnity allows the policyholder to profit from a loss as long as they have the correct coverage. B. The principle of indemnity is designed to restore the policyholder to the same financial position they were in before the loss. C. Under the principle of indemnity, insurance companies are prohibited from reimbursing more than the total value of the insured property. D. The principle of indemnity allows the policyholder to select the amount of compensation based on their perceived value of the property. Answer B. Explanation. The principle of indemnity in property insurance is designed to restore the insured to the same financial position they were in prior to the loss without allowing them to profit from the insurance payout. This principle is central to property insurance policies, ensuring that the insurance provides compensation based on the actual financial loss incurred. Excessive payouts or compensation above the actual loss would violate this principle and create moral hazard. Oklahoma's regulations align with this principle, requiring insurers to reimburse only the value of the loss. Question 8. Which of the following would be considered a prohibited practice under Oklahoma's unfair trade practices laws for insurance producers? A. Producer provides full and honest description of policies exclusions to client. B. Producer tells potential client that life insurance policy includes living benefit when in fact it does not. C. Producer assists client in understanding the details of their policy after purchase, helping them to manage their coverage. D. Producer discloses all fees and commissions associated with policy before the client purchases it. Answer B. Explanation. Misrepresentation is considered an unfair trade practice under Oklahoma's insurance laws. In this case, telling a client that a life insurance policy includes a living benefit when it does not is a clear example of misrepresentation, which is prohibited. Producers must provide truthful and accurate information to clients to ensure fair and transparent business practices. Misleading clients can result in disciplinary actions, including suspension or revocation of the producer's license as outlined by Oklahoma's unfair trade practice regulations. Question 9. Which of the following is the most important consideration when determining the insurable interest in a life insurance policy? A. The relationship between the policyholder and the beneficiary. B. The financial dependency of the policyholder on the insured individual. C. The type of life insurance policy being purchased. D. The number of individuals covered under the policy. Answer B. Explanation. Insurable interest in life insurance is determined by the financial dependency of the policyholder on the life of the insured individual. This means that the policyholder must have a legitimate financial interest in the continued life of the insured. For example, a person can insure the life of a spouse, child, or business partner if they would experience a financial loss upon the death of that individual. This principle ensures that life insurance is used as a financial safety net rather than a speculative tool. Question 10. Which of the following statements regarding Oklahoma's comparative negligence laws in auto insurance is correct? A. Oklahoma's comparative negligence law allows an individual to receive compensation regardless of their own degree of fault in an accident. B. In Oklahoma, an individual can only recover damages if they are found to be less than 50% at fault for the accident. C. Under Oklahoma's comparative negligence law, the individual who is more at fault than the other party is entitled to recover damages. D. Oklahoma's comparative negligence law does not apply to auto insurance claims. Answer B. Explanation. Oklahoma follows a modified comparative negligence rule, which means that an individual can only recover damages if they are found to be less than 50% at fault in an accident. If an individual is 50% or more at fault, they are barred from recovering damages. This is a key element in determining liability and compensation in auto insurance claims and aligns with the state's laws on comparative negligence, which are designed to fairly distribute damages based on the degree of fault in an accident. Question 11. Which of the following would be classified as an exclusion in typical homeowners insurance policy? A. Damage caused by natural disasters such as tornado. B. Damage caused by an intentional act such as vandalism. C. Damage caused by an accident such as kitchen fire. D. Theft of personal property from the home. Answer A. Explanation. Natural disasters like tornadoes are often considered exclusions in homeowners insurance policies unless specifically added through an endorsement. Many standard homeowners policies do not cover damages caused by floods, earthquakes, or tornadoes, requiring separate policies or riders for such coverage. Intentional acts such as vandalism and accidents such as kitchen fires are typically covered depending on the cause. Question 12. What is the primary purpose of the National Association of Insurance Commissioners, NAIC? To regulate insurance rates and premiums in each state. B. To provide insurance for individuals who cannot obtain coverage from private insurers. C. To create model laws and regulations for state insurance departments to adopt. D. To set the pricing for all insurance policies nationwide. Answer C. Explanation. The primary purpose of the National Association of Insurance Commissioners, NAIC, is to provide a forum for state insurance regulators to collaborate on creating model laws, regulations, and policies for the insurance industry. While the NAIC does not directly regulate insurance rates or set pricing, it works to ensure uniformity and effectiveness in insurance regulation across states, allowing for a more consistent and effective insurance market. Question 13. In Oklahoma, which of the following is not a required disclosure by an insurance producer when selling a policy? A. The producer's commission structure and compensation from the sale. B. The financial strength rating of the insurance company offering the policy. C. Full description of the policy's exclusions and limitations. D. The producer's relationship with the insurance company being represented. Answer B. Explanation. In Oklahoma, producers are required to disclose commission structures, policy exclusions, and any relationships they have with the insurance company they represent. However, the financial strength rating of the insurer, while important for consumers to know, is not a mandatory disclosure under state law. Disclosure requirements ensure that consumers are fully informed about the terms and the relationship of their agent to the insurer. Question 14. What is the purpose of an endorsement in an insurance policy? A. To provide extra coverage for a specific item or situation not covered in the base policy. B. To limit the scope of coverage in certain situations. C. To renew the policy for another term. D. To adjust the deductible for claims under the policy. Answer A. Explanation. An endorsement is a modification or addition to the original insurance policy that alters the coverage. It can be used to provide additional coverage for items or risks that are not included in the base policy. Endorsements can be added to customize a policy to fit the needs of the policyholder, such as adding coverage for specific high-value items or extending coverage for certain risks. Question 15. Which of the following describes the principle of utmost good faith in insurance contracts? Both parties must disclose all relevant information truthfully and completely. B. The insurance company must offer the best possible policy terms to the insured. C. The policyholder has the right to request a refund of premiums for unused coverage. D. The insurer must cover all risks, regardless of their nature or cause. Answer A. Explanation. The principle of utmost good faith, also known as Eurimi fidei, means that both the insurer and the insured are required to act honestly and disclose all relevant information when entering into and during the course of the insurance contract. Failure to disclose material facts can lead to avoiding of the policy or denial of claims, as it undermines the contract's integrity. Question 16. Which of the following would be an example of a peril under a typical property insurance policy? A. A storm causing roof damage. B. A burglary in the insured home. C. A fire causing significant damage to a property. D. All of the above. Answer D. Explanation. A peril refers to an event or occurrence that causes damage to property which can be covered under an insurance policy. Examples of perils include storms, burglaries, fires, floods, and other types of loss-causing events. Each peril may be covered differently depending on the specifics of the policy and the type of coverage purchased. Question 17. Which of the following is a common example of moral hazard in insurance? A. A policyholder installs an alarm system in their home to prevent burglary. B. A policyholder purposefully damages their car to collect insurance money. C. A policyholder buys a policy that covers damage caused by floods. D. A policyholder files a claim after a legitimate accident. Answer B. Explanation. Moral hazard refers to the risk that an individual might take on riskier behavior or act fraudulently because they know they are covered by insurance. In this case, a policyholder purposefully damaging their car to collect insurance money is an example of moral hazard. Insurance is meant to cover legitimate risks and losses, but moral hazard involves unethical or reckless behavior to exploit the policy for financial gain. Question 18. Which of the following would not be typically covered under a standard personal auto policy? A. Injuries to a pedestrian caused by the insured driver. B. Damage to the insured's car from a collision. C. Damage caused by an earthquake. D. Liability for injury or property damage to others in an accident. Answer C. Explanation. A standard personal auto policy generally does not cover damage caused by natural disasters such as earthquakes. This type of damage would typically require a separate policy or endorsement. Coverage under an auto policy includes liability for injuries or property damage to others, collision damage to the insured's own vehicle, and damage from specific covered perils, but earthquakes are usually excluded. Question 19. Which of the following is the most common type of life insurance used by individuals seeking both protection and an investment component? A. Term life insurance. B. Whole life insurance. C. Universal life insurance. D. Variable life insurance. Answer B. Explanation. Whole life insurance provides both a death benefit and a cash value component that grows over time. This makes it appealing to those seeking long-term protection and an investment or savings component, unlike term life insurance, which only offers coverage for a set period. Whole life insurance covers the policyholder for life and builds cash value that can be borrowed against or used to pay premiums. Question 20. Which of the following is true about the coinsurance clause in property insurance policy? A. It requires the policyholder to insure their property for its full replacement cost. B. It reduces the amount of premium that the insured must pay. C. It establishes the proportion of the claim the insurer will pay if the property is not insured to its full value. D. It allows for coverage of only the insured's property, excluding liability for third-party damages. Answer C. Explanation. The coinsurance clause is a provision in property insurance policies that encourages policyholders to insure their property for its full value. If the policyholder underinsures their property, the clause requires them to bear a portion of the loss. The insurer will pay only a proportion of the claim based on the ratio of the insured amount to the full value of the property. This helps to ensure that the policyholder shares in the risk of underinsurance. Question 21. Which of the following is the primary purpose of a subrogation clause in an insurance policy? A. To limit the amount an insured can claim for damages. B. To allow the insurance company to recover the amount of a claim paid from a third party responsible for the loss. C. To define the exclusions in a policy. D. To outline the renewal process for an insurance policy. Answer B. Explanation. Subrogation is the process where an insurance company seeks to recover the amount it has paid for a claim from the party that caused the loss. This cause allows the insurer to step into the shoes of the insured and pursue recovery from third parties, ensuring that the responsible party ultimately bears the cost. Question 22. Which of the following is an example of negligence under liability insurance policy? A. A person intentionally harms another. B. A driver runs a red light and causes an accident. C. A business owner pays their employee to handle the task safely. D. An individual accidentally breaks their neighbor's window while playing baseball. Answer B. Explanation. Negligence refers to a failure to exercise the care that a reasonably prudent person would under similar circumstances. In this case, the driver running a red light and causing an accident is an example of negligence, as it shows a lack of care or disregard for traffic laws. Intentional harm, as in A, is not considered negligence. It is an intentional tort. Question 23. Which of the following is typically considered a personal injury under liability insurance policies? A car accident resulting in bodily injury. B. Damage to property caused by the insured. C. Libel, slander, or defamation of character. D. Injury caused by a defective product. Answer C. Explanation. Personal injury in insurance refers to non-physical harm such as libel, slander, or defamation of character. These types of injuries are different from bodily injury, which relates to physical harm, and property damage, which involves harm to property. Personal injury coverage typically addresses these intangible harms. Question 24. Which of the following best describes the concept of insurable interest in an insurance contract? A. The right of an insured to claim any loss, regardless of ownership. B. The requirement that a person must have a financial stake in the property or life they are insuring. C. The ability to buy insurance from any company regardless of risk. D. The insurer's right to cancel a policy if the insured fails to make a claim. Answer B. Explanation. Insurable interest is a fundamental principle in insurance that requires the policyholder to have a financial or emotional stake in the property or life being insured. This ensures that the insurance contract is legitimate and not taken out for speculative purposes, preventing fraud or moral hazard. Question 25. Which of the following is an example of underwriting in the context of insurance? A. The process of determining if a claim is valid. B. The process of investigating a potential customer's credit history. C. The process of evaluating risks to determine whether to offer insurance coverage. D. The process of setting the premium rates for a policy. Answer C. Explanation. Underwriting is the process through which an insurance company evaluates the risks associated with an applicant and decides whether to offer coverage, at what level, and at what premium rate. The goal of underwriting is to assess risk and ensure that the policy is appropriately priced based on that risk. Question 26. Which of the following statements about exclusions in an insurance policy is true? A. Exclusions broaden the scope of coverage. B. Exclusions limit or remove coverage for specific risks or situations. C. Exclusions are not mentioned in the policy. D. Exclusions only apply to liability coverage. Answer B. Explanation. Exclusions in an insurance policy are specific situations or risks that are not covered by the policy. They help define the scope of the coverage and prevent claims for situations that the insurer does not wish to assume responsibility for, such as damage caused by war, wear and tear, or intentional acts. Question 27. Which of the following is an example of replacement cost coverage under a property insurance policy? A. The policy pays for the current market value of the damaged property. B. The policy pays for the amount needed to repair or replace the damaged property without factoring depreciation. C. The policy pays for the cost of temporary living arrangements for the insured. D. The policy covers only the repair costs after a deductible is applied. Answer B. Explanation. Replacement cost coverage means that the insurer will pay the amount necessary to repair or replace damaged property without considering depreciation. This is in contrast to actual cash value coverage, which factors in depreciation and only pays the value of the property at the time of the loss. Question 20. Which of the following best describes a flood in the context of a property insurance policy? A. Any water damage caused by a burst pipe inside a home. B. Water damage caused by an external event like heavy rainfall, river overflow, or storm surges. C. Water damage caused by the homeowner's negligence. such as leaky roof. D. Any water damage, regardless of the source. Answer B. Explanation. A flood in the context of property insurance is typically defined as water damage caused by an external event, such as heavy rainfall, river overflow, or storm surges. Flood damage is generally excluded from standard homeowners policies and requires separate flood insurance to be covered. Question 29. Which of the following is true about liability coverage in an auto insurance policy? A. Liability coverage covers damage to the insured's vehicle. B. Liability coverage covers only the insured's bodily injuries in an accident. C. Liability coverage provides compensation for injury or damage to others caused by the insured. D. Liability coverage is optional for most states. Answer C. Explanation. Liability coverage in an auto insurance policy is designed to pay for bodily injury and property damage caused to others in an accident where the insured is at fault. It does not cover damage to the insured's owned vehicle, which is typically covered by collision or comprehensive coverage. Most states require drivers to carry some form of liability insurance. Question 30. Which of the following is typically not covered under a standard renter's insurance policy? A. Personal property theft. B. Liability for damage caused by the insured to others' property. C. Flood damage to the rental property. D. Additional living expenses if the rental property becomes uninhabitable due to covered loss. Answer C. Explanation. A standard renter's insurance policy generally covers personal property liability and additional living expenses if the rental property becomes uninhabitable due to a covered event. However, flood damage is typically excluded from renter's insurance, and additional coverage would need to be purchased separately to protect against floods.